Hello everyone, and welcome back to the channel. Today, we're re-diving into a question that is on every investor's mind. Will the Fed cut interest rates again in 2026? After the cuts we saw in late 2025, which brought the target rate down, the big question is what comes next. I believe the answer is yes, and here's why the Fed is likely to make more cuts this year. First, let's talk about something called passive tightening. This sounds complicated, but it's actually a super important concept. The real interest rate is the Fed's rate minus inflation. As inflation continues to cool down, if the Fed does nothing and keeps rates flat, borrowing actually becomes more expensive in real terms. Think about it. If inflation is projected to be around 2.4% and the Fed holds rates at 3.75%, that's a bigger gap. This quietly squeezes the economy without the Fed even taking action. To prevent this accidental tightening and maintain a neutral stance, they have to lower rates as inflation falls. The second reason is the Fed's dual mandate: stable prices and maximum employment. For the past few years, the focus has been all about fighting inflation. But now, with inflation getting closer to the Fed's target, their attention is shifting back to the job market. We've seen unemployment tick up slightly to around 4.4%. While this isn't a crisis, it is a warning sign that the economy is softening. The Fed wants to avoid a hard landing and a potential recession. By cutting rates, they make it cheaper for businesses to borrow, invest, and most importantly, hire. It's about protecting jobs and ensuring the economy keeps chugging along smoothly. Finally, it's all about getting back to normal, or what economists call the neutral rate. The current interest rate is still considered restrictive, meaning it's actively slowing down the economy. The long-term goal is to get back to a rate that neither boosts nor restricts growth, which is estimated to be somewhere between 2.5% and 3%. To get from where we are now to that neutral zone, we'd need about 2 or 3 more quarter-point cuts throughout the year. Now, of course, nothing is guaranteed. If inflation suddenly gets sticky and stays above 2.5%, or if the economy unexpectedly heats up again, the Fed might decide to pause. Some of the more hawkish voices are already pointing to these risks. However, the most likely scenario is that the Fed will continue to cut rates. These aren't emergency cuts like we saw in past crises. Instead, think of them as careful adjustments, fine-tuning the economy to make sure the soft landing we achieved in 2025 doesn't turn into a stall in 2026. That's my take on the situation. What do you think? Let me know your thoughts in the comments below. Thanks for watching, and don't forget to like and subscribe for more economic insights. See you in the next video.